It's been a big week for economic news. Obviously, we've had our first interest rate rise out of the ECB, that pushing rates up by 1.25%. The Bank of England have left rates unchanged at the moment, but really the betting is on how long it will be before the UK starts to increase rates. Indeed, just on Friday, today we've had input and output prices in the UK coming in much higher than expected. That's clearly inflationary, and the initial reaction to that is that sterling has increased in value. Gilt prices have come down, and the reading of that, of course, is that it may not be long before the UK joins the ECB in pushing rates up. So if we just first of all take a look at some charts, the first chart I want to show is what we call the short sterling future contract. And the green line is the UK interest rate expectation, and the white line is the ECB. Now this is a chart which is the inverse, so the lower it goes, the higher interest rates move. And this is quite a long dated chart. It looks out into the future. It's looking out until 2016. And what it's telling you is that the ECB clearly making that first move, and there will be a gap probably through to December 2013, but that actually, if we were to believe the growth forecast for the UK, sort of 2012, 13, 14 onwards, that rates will be catching up. And it's implying, as I say, a 4% interest rate in the UK probably by about 2016. So interest rates very much key to the whole thing at the moment. Pleasingly, the equity markets are absorbing this news, as they should. To some extent, a lot of these prices have been priced in over the course of the last few months. And indeed, the FTSE 100 at the moment is holding very steadily, close to its highs for the year. So it has fully recovered the losses that were incurred just a few weeks back from the Japanese earthquake. I do want to look at currencies as well, because we've been mentioning this over the last 2 or 3 weeks about how we believe currencies are going to play a much more meaningful impact going forward. Up until now, we've had a fair amount of stability in currencies, but you may recall the G7 stepping into the currency market and supporting the sort of, or trying to weaken the Japanese yen. Japanese yen over the course of the last 2 or 3 years has been incredibly strong, with 20 to 30% appreciation relative to a basket of other currencies, and that was all getting incredibly expensive for what is an exporting nation. They stepped in to really short the yen, and since that time one of the key beneficiaries has been the Australian dollar. And I just want to show this chart here. That's a mid-March point on the chart, and really just to see how strongly the Australian dollar is now presenting itself. So we'll have some ramifications, I suspect, for some of the mining stocks that are out there. Mining stocks, by the way, doing well. Copper prices back up to near new highs. Now, the other key development of the week was Portugal. The bailout number has been agreed, and if we just take a look at Portuguese bonds, they haven't really moved much in the context. That's the price of the bonds, so yields remaining very high. I still believe there's a lot to work out here, because as we know, the Portuguese voted against an austerity budget, and that's what's led to this bailout. Conditions are being negotiated at the moment as to what that bailout will involve. My suspicion at the moment is there's still quite a lot of negotiation to be done. All eyes on Spain, but at the moment Spanish bonds are behaving themselves. Turning to the company level, and I think the other big area for me is the banking sector. We are going into the corporate reporting season, starting in the US. JPMorgan will be reporting shortly. They will be the first out. But there are still some fairly significant capital raisings that are taking place at the moment. We've seen this week two such fundraisings. If we take a look here at Commerce Bank, which raised money, there have been other examples around. Saying all of that, I think the banking sector is looking quite good at the moment. We had a presentation from Lloyds Bank this week, which felt very much things are under control. They've obviously stress tested everything. Their exposure to Ireland is now sort of fully understood, and the net result of that is that the banking sector is demonstrating some relative strength despite these capital raisings. This is a chart of global banks as measured by the MSCI, and you can see that chart is very much in an uptrend and supportive of the FTSE rally. One other stock just to highlight, which we had the buy note out on, is Google, and what we find fascinating about Google is how cheap it looks on paper. If you strip out those huge cash balances from its earnings number, clearly cash is not earning a lot of money, but if you were to strip that out and look at the underlying earnings, we think the multiple looks quite modest in the sort of 12-13 range, and we're putting a buy note out on Google as we speak. Just finally returning to the domestic scene, the retailers, we've continued to comment on these over the last 2 or 3 weeks as we suspect they were going to be a feature. In fairness, Marks and Spencer pleased the market with their numbers. I think it was a solid statement from them, and their shares have responded accordingly. However, on the other side of the coin, Carpetright, a further profit warning from them. Profits are going to be well down on last year's numbers. The share price, as you can see, has been coming under pressure. So still pretty much a weak environment. Marks and Spencer proving to be almost the lone best performer in that space.